Welcome to Stocks and Bonds Extended. If you're hanging around, then you're ready to fill your head with more knowledge, so you become the best investor possible. Let's talk more about stocks and bonds, and I'm breaking up these two important subjects into their own videos. So up next, I'm talking about debt, interest, coupons, maturities, risk, safety, consistency. It must be the wonderful world of bonds. I'm Ian Goldie. This is Finance in 5 Bonds. In the first segment, we spoke in broad terms, with the general knowledge of stocks you own and bonds you loan. Now in this section, let's get more into the details of making an investment into stocks or bonds. And this discussion is towards individual purchases for stocks and bonds. And in a separate video, I go more into depth about pooled investments found in an ETF, exchange traded fund, or a mutual fund, or some type of private collective. Now, I've been a private wealth and portfolio manager for 25 years. And in my initial discussions with new clients, I try and teach them the importance of bonds. And in my opinion, you can't become a truly great investor until you understand bonds and debt. Now, what are we talking about when we dive into something more that's basic? It's an entire course summarized in just a few minutes, designed so you could go back one or more times to review material and absorb this at your own rate and method. According to the IFF, Institute of International Finance, in July of 2020, global debt was $327 trillion. And according to this 2020 report from Statista, the global stock market is smaller. It's $32.47 trillion. So bonds are important, not only because they're much larger than the stock market, but because of the basics and understanding of risk and return. In another video, I talk about risk and return, but for this purpose, let me illustrate on a historical bond. I'm going to throw this to my partner, Adam Myers, who's back in the office, and he can explain the historical yields of a U.S. Treasury. Adam?
Thanks, Ian. I'd be happy to show our viewers some incredible opportunities that have existed in bonds that have outperformed stocks on a net return and a risk-adjusted basis. If we remember the 1970s and early 80s, the government was experiencing inflation and the world was in crisis. The stock market was volatile, but the bond market was the place to buy. In 1982, an investor could have purchased a 30-year U.S. Treasury bond, considered one of the safest investments in the world, and get locked into a rate of return of 14.2% for 3 decades. During those 30 years, a great deal of volatility was seen in the global markets. Your stock investments were on a roller coaster ride, but for the bond investor who locked into their high rate of return, watched as market fluctuations only made their boring, low-risk bonds look really good. You see, in time of crisis, investors often sell riskier investments like stocks and look for safer investments such as debt issued by strong countries with healthy balance sheets and good economies. Today, with the 30-year Treasury paying 1.2%, many investors are kicking themselves for not locking into higher rate, safer investment earlier. Hindsight is 2020, and with interest rates this low, it's likely investing in a 30-year bond today might result in an opportunity loss as rates start to climb higher. I'll toss it back to you, Ian, so you can explain how you can lose money holding bonds if interest rates change.
Thanks, Adam. There have been many great opportunities to make money in bonds. But you can also lose money with bonds. Now, many investors don't know how you could lose money while owning bonds, so let me explain a variety of ways you can with individual bonds or funds. If something was priced at $100 a month ago, but now all the stores have lowered the price to $75. Would you buy it today? No, you wouldn't. You might say to the seller, look, I'm sorry you paid a higher price a month ago, but today's price is 25% less. And that is what I will pay if you want to sell me one of those. Take that same analogy and apply it to bonds. If rates go up, then I don't want your lower paying bond if I can buy a higher rate today. Bonds trade in a marketplace, and that marketplace determines what something is worth. And for bonds, the factors are rate, credit quality, and time to maturity. Now, we're about to dive into details regarding bonds, so I'm going to do my best job to be brief, but also not skip over any points that are relevant to buying bonds and understanding what you're looking for to